What's going on, everyone? Welcome back to Financial Knowledge, where I bring finance and investing related advice. In today's video, I'll be sharing 3 simple steps you can use to help you invest in a recession. Now, with coronavirus being a global pandemic and a lot of countries being in lockdown, it's been quite uncertain times for a lot of businesses, and there's also been a lot of volatile changes in the stock market. Along with these changes, there have also come great investment opportunities. Now, if you're a new investor or you just want a bit more information, this video will teach you how to take advantage of these economic changes and how you can use them to improve your investments and make a greater profit. The 3 steps that I'm going to cover is picking the right business, what type of investor you want to be, and how to allocate the money that you have so you can best take advantage of the opportunities that are arising and reduce some of the stress that can come with investing in a recession. If you find any of the content useful or want to help support the channel, feel free to leave a like or subscribe. Now, without further ado, let's jump into the content. Now, for the first tip, picking the right business. While the shutdown has affected a lot of businesses negatively, depending on the type of business model that a company has, it can also be very beneficial. As I'm sure you can all imagine, all the companies that require people to physically come to the stores and purchase the products that they have had a lot of financial stress placed on them. However, those with an online business structure have greatly benefited from the lockdown. As an example of this, we can take a look at the company Amazon, which has a large amount of income streams and also has physical stores, but the majority of its finances are related to e-commerce or online sales. Just to illustrate my point, I'll bring up the finances for Amazon, and you can see that the online components of the business have grown at a far greater rate than the physical aspects. As you can see, the growth of the physical stores is currently sitting at 13%. If you look at the online sales, they're sitting at 48%, along with the third-party seller rate, which is sitting at a 52% increase. You can see that the online components have grown at a far greater rate than the physical stores. Their stock price has risen by roughly 66% this year alone. For a company like Amazon, where e-commerce is a strong foundation of the business, it's quite useful for something like a lockdown to happen because people still need to buy things, and as Amazon is a large online distributor, it can take full advantage of this, and people will deviate from physical store purchases to e-commerce using platforms such as Amazon. Now, companies that require a physical store component have been greatly challenged by the lockdowns that have occurred. The one I'm going to be discussing is McDonald's. Now, with a company like McDonald's that relies largely on physical store sales, the lockdown has greatly affected the profit that this company can make. This can be reflected in its stock price, which has only gone up by 3% this year. The way McDonald's makes money is that franchisees will pay McDonald's the right to open up a restaurant, and they will be liable for supplying all the equipment, hiring the staff, and fixing any repairs. McDonald's owns the land that the restaurant is built on, and then will receive royalties from the franchisee coming from the sales that the restaurant makes, and also the franchisee paying rent to McDonald's. With less people coming to the stores and the operations being largely restricted to drive-through or delivery options, less sales are being made, and therefore less royalties can be paid to McDonald's, and also the amount of money available for rent is also reduced. The construction of new stores has also been affected, and therefore less franchisees are able to pay McDonald's. The second tip that I have is, what type of investor do you want to be? The 2 main types that there are passive and active investing. So just to give you a bit of context on what these 2 investing types are all about, passive investing is when you're not trying to beat the market by picking an individual company. Instead, you're just trying to participate in the market. So you might invest in something like an index fund, for example the S&P 500, which consists of the top 500 companies in the US. With this style of investing, your money is spread out amongst all the companies that make up that index. So if you put $1,000 in the S&P 500, that $1,000 would be spread out amongst all 500 companies that make up that index. Now, this leads to a lower annual return, which is estimated to be roughly 7 to 10% per year. So the amount of money you make is just a slow, consistent growth over time, which reflects the overall growth of the stock market as a whole. So if you want to be an active investor, as the name would describe, it requires a lot more active input from the investor in terms of selecting individual businesses, researching companies, understanding the management, how the business operates, because you have to understand the business you're investing in order to make a profit. Because with this, you're putting your money in the individual company, and understanding the business and knowing how it operates and how it makes money is key to making a return. And with active investing, there's a far greater ability to make a greater return with the money that you put in. And a good benchmark to have is aiming for roughly 15% per year, but it is possible to double or triple your money. And this is not common and it doesn't always happen, but it's something that you can do. And if you put the right amount of time in and select the correct businesses, it's definitely something which is doable. Moving on to the third and final tip of not putting all of your money into the stock market at once. With this large drop in the S&P 500, a lot of investing opportunities were made, because prior to this, a lot of companies were overvalued in relation to what their fair or intrinsic value should be. Now, when the S&P 500 dropped to roughly 35%, there was a correction to the share price of a lot of companies, and it put them at an undervalued category. So essentially getting the company at a discounted rate. Think of it the same as if there's a sale at a shopping center when you're going to buy things. Essentially a similar thing happened to the stock market. When a company drops below its fair or intrinsic value, this is called a margin of safety. And when you're buying companies, you want the margin of safety to be roughly between 30 and 50%. Now, when this drop in the S&P 500 occurred, a lot of companies which were previously overvalued dropped into this 30 to 50% margin of safety range. It's best to buy companies when they're at a discounted rate or at a margin of safety price. So for example, if you're looking at a company and it's dropped by say 30% and you think it's a good buy, you have to consider that the market can drop further, especially in a recession, as there's a lot of volatility. Say for example, if you had $10,000 available to invest, and if you put your whole $10,000 in and it drops maybe by another 30%, you'll feel quite bad because you've automatically lost money, and also you can't take advantage of this further reduction in share price. Just put $5,000 in at that 30% margin of safety, and then the price of the share dropped further, you'd be able to invest that other $5,000 and take advantage of that reduction in price. And then over time, if you pick a high quality business with a good long-term financial outlook, over time the price of that share would increase and you'd make a profit on your investment. But if, for example, the opposite happens and instead of the price dropping, it just rebounds, and you only put your $5,000 in, you might be annoyed and wish you put the whole $10,000 in. You still got to be happy with the return you've made if the price starts going up and you're making a profit from the money that you've put in. So just to recap, the 3 tips are picking the right type of company, selecting what type of investor you want to be, and finally considering the volatility of the market and how you invest your money. I hope you found the content useful and you can use these tips to improve your returns and make a greater profit with your investments. If you want to subscribe to the channel or watch any future videos, feel free to click the links on screen, and I'll see you guys in the next video.